This is a regular monthly update which we provided to all the network people, and in this we try to cover the market from 360-degree perspective. In the sense, we try to cover it from fundamental side, technical side, and derivative side. So in that respect, today we are following the similar process every time which we follow. This is what the schedule is for today's meeting. What we will be doing in today's morning update. So I know a lot of people, you people will be quite concerned about the equity market right now, and we had seen long journey of around 1.5 year starting from March 2020 to almost up to October 2021. Long journey of very up bull market, which was supported by multiple reasons and multiple way of funding supporting the market. And we had seen in this period a lot of people, new people got joined to this market rally who have not seen corrections earlier in the market. So this is a new experience for the people who have joined the market recently, and as such find it very confusing what is happening in the market, why the prices has corrected a lot for few stocks, and there are a lot of other stocks which are still stable. So to discuss all these things, first of all, would like to give market outlook for the coming month and how we see the market from here. We were talking consistently in the past, even if you see our monthly report of October, November, December, every month we were talking and showing concern about the high commodity prices. This is not just because of the war which has led up all these commodity prices higher, but that definitely acted as a fuel in the fire. Commodity prices went up much higher level and much before this war from the level before COVID, and they were high by about 100% to even 500%. And these commodities were not limited to few part of the commodities, but across the board there was a lot of price increase which has happened in that period. So definitely those high commodity prices were not sustainable. Company got benefited because of increasing prices as the inflationary economy add up to the earning, which got disturbed because ultimately the final consumer has to pay all the prices for it, those commodity prices increases, and these consumers were finding it difficult in the later part of the period, wherein these people started resiliating the higher commodity prices. And even if we talk about the central banks, we feel they were late in taking actions in controlling inflations, taking a step to control inflations. And that's why they have to hurry up now to control the inflation, because to control the inflation now they are increasing interest rates substantially. Like Fed has increased the interest rate by 0.75%, which was never seen earlier in recent history. Similarly, RBI has to come up in between to raise the interest rate, and in 2 months itself, they increased the interest rate by 0.75. So all these things has the higher prices has put the pressure on central bank to control inflation, and because of the inflations. Now, if you talk about what they are likely to do, central banks, to control inflation, they are taking steps to control inflation and putting a priority on controlling the inflation than on the growth. And as such, the growth, they are slowing down. If the growth slow down, definitely there will be an impact on the economy, uh, because share market always look for the growth. And if the growth is slowed down, then definitely there is a impact on the earnings of the corporates. So post these actions, we have started seeing some green shoots in the corrections of the commodity prices in different part of the world, like what we had seen in the steel prices. Though in India, it was also driven by government action. But internationally also, even without India exporting around 20 million ton of steel in international market, the steel demand and supply is getting mismatched and prices are correcting. So similarly, if you see the metal prices, aluminum, copper, all are down by a substantial amount from peak. Even if like PVC, which was before COVID around $900, went up to around $1,600. Now it is at around $1,250. So prices are correcting because of lower demand. So definitely lower demand will have some impact on some companies which are producing that. But there are still concerns on few commodities like crude and thermal coal. Though no doubt coking coal, which is consumed by steel, has come down, but thermal coal has in this period, in fact, has increased. If we talk about last 1 month, it has increased by 10%, and crude is also continue to remain high. So these two energy prices are keeping it high. This may be because of the war between Russia and Ukraine is still continuing and not subsiding, and which is disrupting the supply chain of all these two commodities, or maybe used by Russia to fund its war. So quite possible they are the major supplier of these commodities. So what we see that the impact of Fed tightening is now getting visible, but not fully. Still, there is there is some way to go to get the things corrected, and because of that, even if Fed we talk about, they still hold up their stand, and expected is that they will be further increasing the interest rate by 0.75 in the next meeting also. So it's midway, we can say, not finally. So whatever the Fed is taking action, we are seeing some benefit of that. No doubt there are different impact for different corporate results. The key thing is that Indian market is, even in this period, even in this last 1 month, has outperformed. And also, if we see year to date, also we are outperforming the other markets, larger markets. This is mainly because of two reasons. One is India dependence on international market is comparatively lesser, and it's a more of a domestic dependent economy. And second reason is that there is a lot of support from the domestic money, which is helping the equity market from the supply of money, whereas FIR continue to sell in the market. So these are the reasons why Indian market is outperforming as compared to the other emerging market or even developed market as well. So the impact of the Fed tightening will be visible now in corporate result as well. So what we will be seeing in the corporate results, that because of the commodity prices declining, there will be two type of impact on different type of companies. Companies which are producing those commodities will have negative impact because the commodity prices are coming off, whereas the companies which are using all these commodities or consuming these commodities will have a positive impact. But there will be a time lag for that. Means the producing company will get impacted immediately, whereas whereas consuming company will get the benefit with lag because they have inventory in their pipeline, and with the declining prices, the sales declines because no one want to carry the inventory, they want to dispose of the inventory and all. So what will be the scene in the coming quarter, that declining part will be visible for producing company, and the producing company will see bad results immediately, whereas the producing company results benefit will not be coming in this quarter, but it will be with the lag, maybe in the coming quarters. So one should keep this phenomena in mind while investing now. There was a big cycle which was going on of the commodity, which is coming off, and still it's on the way and not yet found the bottom. So don't try to venture into those commodities. Try to avoid the direct commodity producers and all, and rather look for the companies which are consuming those commodities. Post the recent corrections, even the valuations has also become attractive, which we were consistently talking that the valuations are much above the pre-COVID or higher levels and running very high. Now, if we talk about the valuations, they are at reasonable level. We are not saying that it is attractive or very attractive, but yeah, definitely it's a reasonable level valuation which has come, and one can look for good companies at current point of time, and do be selective on that part also. So what we feel that one should avoid commodity companies related stocks, and start accumulating consumption driven and domestic led stocks. So the problem in the world market will be larger, specifically developed, because people are even talking about recessions in Europe and US. So it's better to avoid that part of the economy business, and try to put up money in the domestic economy, which is likely to continue to show growth. And though there could be some up and down, but still a reasonable growth will be there in the overall economy. So the sectors which we like at current point of times are FMCG, auto, capital goods, banking, and consumer durable. So all this looks attractive from a medium term perspective. Overall, what we feel that Nifty range for the July series seems to be a more of a range bound, and likely to be within range of 15,300 to 16,300. This is from my side. I'll request Jehan to talk about the stocks.
Yes. Good morning, everyone. So our first fundamental stock for this month is Rolex Rings. How we have arrived at this company, I will just briefly tell you. We have noticed that on the macro side, if we look at top down, then one sector which has been outperforming and many stocks in that sector are witnessing good order books and stocks making new all-time highs is the capital goods sector, which is a play on the industrial revival in India. And also our view is that going forward with the chip shortages, becoming less and less of a problem, auto sector will start performing from this month onwards. Secondly, even on the bottom up front, we saw that post listing, all the 4 quarters that this company has delivered has witnessed very good growth and good return on investment being delivered. So this is how we arrived at a top down, and then we dig deeper into this company. So what this company does, it mainly makes 2 products. One is the bearing rings, which is 60% of revenue, and other are auto components, where it makes forged components like wheel hubs, shafts, spindles, and gears. It has the fifth largest forging capacity in India. What is bearing ring? It is there are two kinds of rings which are there in every bearing, the inner and outer ring, and this together forms out of, let's say, around 100 rupees of bearing, 20 rupees comes from these two bearings. So this is the market in short. The relevance of this product is that it is a very critical product, and the tolerance levels requirements are very strict from the OEMs, which are bearing companies, large MNCs like Timken, Schaeffler, SKF. And so there is a lot of technology involved in developing and manufacturing this product. This acts as an entry barrier, as the large MNC OEMs do not approve any new vendors very easily. So if we look at bearings industry size, that is at 12,000 crores. Out of this, almost 40% is imported. So domestic production would be around 7,000 crores, out of which bearing rings market size is around 2,200 crores. Within this, there are three ways of making bearing rings. The most difficult and technology where a lot of complexity is involved and the application is critical is the forged rings. This market is half of the total bearing rings market, which is 1100 crores. The other methods of making bearing rings are have more competition and are lesser complex. So if we look at forged rings market, out of this 1100 crore, Rolex rings has around 32% market share, and the balance market share is with other three players. The company's revenue mix is such that almost 60% is exports and around 40% is domestic. Sir, can you move to the next slide? If we look at in terms of segment wise, how the revenue is split, passenger vehicles is at 40%, commercial vehicles 27%, electric vehicles 7%, and industrial at 26%. Now, if we look at what are the tailwinds that are backing this company and how the company is able to grow at 30% plus since last many quarters. As I said, the 40% of bearings are imported today, and thus large bearing companies are focused on import substitution. Many companies like Timken, Schaeffler are opening new plants in India, and they are using these plants as outsourcing hubs and even exporting to other countries. For example, Timken has been exporting 25% of its sales out of India. If we look at order book of all capital goods companies, they are at all-time highs. You can take any company, and we will see that even their stocks are at all-time highs. This is happening after a period of almost 8 to 10 years. Previously, if we see, then their order books peaked in 2012 to 2014 years, and after a long time, we are seeing a revival in the investment cycle in India, and this is reflected in order books of all companies. The third trigger is the new business wins, where global companies are seeing India as an outsourcing hub, as well as a China plus one factor acting in favor. In the last year itself, the company won 3 new large clients, and these clients will be ramping up gradually over next 2 years. This year, for example, 80 crore revenue will come from just these new clients, and next year this 80 crore will become 200 crore as the ramp up gains momentum. How typically ramp up process works in auto ancillaries is that initially company will try with just one product with any auto ancillary company, and for just one plant. But after it gains confidence, after a year or a couple of years, it will start giving more orders for other products as well, and then eventually expand the entire product basket to its all its plants all over the world. So that is why we will see that over a period of time, the revenue will keep expanding from a single client. And the fourth trigger is the electric vehicle business, where which involves, if we look at a typical bearing requirement in a ICE car, which is a traditional car, that is a traditional car requires around 18 to 20 bearings, while an EV requires around just 10 bearings. So although the number of bearings is lesser in EV, but the value addition is much higher than that of a traditional car or an ICE car. So if we look at the overall value, it will be higher than ICE car, and that is the reason that the revenue mix from EV will increase from 7% last year to 13% this year, and it will keep going higher. Also, margins over here are higher because of higher value addition. Just an example of one of the EV customers that company has, Tesla has shifted its base for sourcing from some parts, including bearings, from China to India, and that is benefiting Rolex. We expect Rolex to grow its top line and profits at 23% and 33% CAGR over next 2 years. And we value the stock at 28 times FY24 earnings at a 10% discount to tier 1 ancillaries, which include Bharat Forge, Endurance, Minda Industries, which are top-notch ancillaries. And company is posting ROC, which is similar or in fact even higher than these companies. And if we compare the valuation to other large bearing companies, then we are valuing it at 30% discount. So we are getting to a target of 2400, which we feel is reasonable. Sir, we can go to the next stock. Yeah, the second company from fundamental side is Time Technoplast. Company is basically into, we can divide the business in two parts: the traditional products, which has hurt the company in the last decade. If we see the image of perception of the company has been that of a commodity, low ROC, and although it being the largest polymer drum manufacturer globally, which is the core business, you must have seen this product also, that these are blue large drums which are used for transporting chemicals. Apart from this conventional opportunity of conversion from steel drums to the new opportunity of China plus one, which is also acting in favor. This has resulted in a slight increase in growth rate of this traditional product also, whereby we are expecting around 12% kind of growth in this segment, as India is becoming a manufacturing hub for chemicals. While if we talk about the value-added products segment, which is where the mix is expected to increase from 20% today to 33% 3 years down the line. This segment is an oligopoly. There are not many competitors from India, and even the ROC is not upwards of 20% in this segment. More than half of the revenue from this segment is coming from composite cylinders, which is nothing but polymer-based cylinder or plastic cylinders. And the rest of the revenue is coming from intermediate bulk containers and MOX films. Intermediate bulk containers are nothing but very large containers, similar to what usage the polymer drum is used for, but they are much larger in size and difficult to manufacture. That is why even here the company has an edge and margins are much higher. MOX films are nothing but the blue films which you must have seen, which are used to protect against rains. Now, if we talk about composite cylinders, what is the trigger over here? These are used mainly for transporting CNG to pumps, pumping stations. And if we compare the traditional way of transporting CNG to pumps, it has always been through steel cascades. Cascade is a steel cage where it is loaded onto a truck, and the gas is CNG is transported that way. What the advantage of composite cylinder is that although cost is initially 2 times that of a steel cascade, but the weight carrying capacity of that particular truck doubles, making it operationally much more profitable. So once you give the buy the composite cascade by paying 2 times the initial investment, but then every time the truck does the journey, it can carry 2x of the weight which it could carry earlier in steel cylinders. So that way the operational efficiency kicks in and it becomes viable. So we are seeing a good amount of demand from this side. Also, government has been emphasizing on expanding CNG pumps, and we are expecting that from 3,000 today, by 2030, these CNG pumps all over India will increase to 11,000 pumps. This has been the trigger for even for Everest Kanto, which we have been discussing regularly. Second value driver for this company is that management has realized that over last decade or so, the return ratios have been very low, and they have to take some tough decisions, which they are now taking. They are exiting the overseas business, where growth is lesser compared to the domestic opportunity and the value-added products. So they will be exiting all overseas businesses and plants, and they are expected to get post-tax amount of around 400 crores, which they will use to retire debt, and this will strengthen their balance sheet as well as improve ROCE. Once this sale transaction goes through, we think that the perception of the company in investors' minds will change from that of commodity products with very low ROCE and low growth to that of company focusing on value-added products like composite cylinders, which is having high growth, and overall ROCE of the company will also improve every year. We value this company at conservatively at 14 times FY24. Why 14 times? Because it's long-term top-line growth expectation we feel for the company is around 14-15%. However, bottom line, we are confident that bottom line can grow at even 18-20% for next many years to come, as the share of value-added products expands. The EBITDA margin will continuously increase in coming years. So we come with a target of 155 rupees at 14 times FY24 for Time Technoplast. Thank you. That's it from my side.
Thank you, Jihan. Good morning, all of you. This is Swati. Today I will be covering the technical outlook for the Nifty, Bank Nifty, and the two picks that we are recommending for this series. Now, last month we have seen that the bulls was very much active, and Nifty has quoted a low of 15,183 at around that level. And from there onwards, we have witnessed some sort of a pullback rally, which took a Nifty towards 15,920 levels. So that was the June series. We have seen both the games on both the sides, bulls as well as bears. Now this month, technically, as of now, if you look towards the chart which has been displayed on your right hand side, that the Nifty is trading in a downward sloping channel, which gives us some sort of a cautious sign. Technically, also the interesting fact that the Nifty as of now is taking a very strong resistance of 20 DMA, that is 20 days moving average, which comes to at around 16,000 psychological mark. As long as Nifty trades below 16,000 levels, we are not going to witness any kind of a major pullback rally, or say the positive fresh buying we cannot be seen into the market. From the last 4 to 5 trading sessions, once the Nifty was facing a strong resistance at around 15,900 levels, but it was maintaining a very strong support at around 15,400 levels. So as long as it sustains about at 15,400 level, we are likely to witness a small pullbacks rally towards 15,900 to 16,000 levels. Once the Nifty gives the breakdown of 15,400 levels, then the selling pressure is likely to be intensified, which might take a Nifty back towards to 15,100 levels, and below that level, 14,800 levels can be seen. The overall view on the Nifty will remain a cautious as long as it trades below 15,900 to 16,000 levels. So as of now, we believe that the Nifty is likely to be remain to the range bound trading session in the July series as well. But definitely it's a stock specific market. One can initiate their positions on the long side as well, but with the strict stop losses. Coming towards the bank Nifty, we are witnessing a very strong resistance at around 34,130 levels. As long as Nifty trades below that level, major pullback rally cannot be witnessed into the bank Nifty as well. But once it manages to give a breakout of 34,130 levels on the closing basis, at least for 1 to 2 trading session, then definitely 35,000 level and 35,400 levels can be seen in the short period. On the flip side, 33,000 will act as a crucial support level on the bank Nifty front. The overall view on the bank nifty also will remain a cautious. We are likely to witness sideways momentum into the bank nifty also. Coming towards this, sir, request you to move on to the next slide. This month we are witnessing we are just recommending a two buy recommendation. First one will be on a ITC. Why we are recommending this particular counter? Because technically the stock has given a breakout of the sideways momentum. Interesting fact that it was just trading within the range of 260 to 275 levels from the last couple of trading session, and yesterday we have seen a major breakout with the good volumes, which gives a very positive sign. Interesting fact that 100 200 DMA, the stock is trading above all those important averages, suggesting a potential up move in the near terms. Now I believe the stock is on the verge of giving the breakout of 52-week high also, and it may quote a new 52-week high, which comes to at around probably near 300 marks also. So we are recommending ITC buy at the current levels. If we are getting any dips towards 273, one can add on. We are looking for a target of 300 and 310 levels on the higher sides with the strict stop loss of a 262. The next counter we are recommending for this month will be on Larson's and Toubro, that is LNT. This particular stock is just given a breakout of a downward sloping trend line. The chart has been displayed on the right hand side. I have just drawn the downward sloping trend line, which is indicated by the black line. We can witness that from last couple of trading session, the stock has given a breakout of this trend line, and it is just heading on an upside. Also, the 20 days moving average, red line indicated the stock is just trading above its 20 DMA, which gives a very positive sign. Even though the market was correcting, this particular stock is just trading in the upward direction, which gives a strong indication on the technical setup. Momentum indicators such as RSI, we are witnessing a positive crossover in the daily chart, so which gives also positive sign on the daily counter. I believe the stock has a potential to reach up to 1670 to 1720 levels on the higher side. So one can take a long position at the current market price, that is 1570 levels. If you are getting any dips towards to 1520, one can add on for immediate target of 1670 and 1720 with a strict stop loss of 1470. I think that's it from my end. I request derivative guys to take the call forward.
Yeah, thank you, Swati. Hi, this is Nirav here from me and Amit. Good morning to everyone. I believe Nifty definitely for this month, from looking at the rollovers aren't, really helpful in tackling the problem where you're seeing a lot of stocks, witnessing selling pressure in the last 2 or 3 months. For this month, definitely the rollovers are range bound, and that can probably be a very good sign, going forward for the next, couple of months. Why? Because we have seen even after average rollovers, we are seeing selling pressure in the last 3 or 4 months. And now what has happened is there is total range bound rollovers which have happened. For Nifty, the rollovers are only 75%. But in terms of open interest, 1 crore 12 lakh shares have been rolled over for the July series, and that is basically what had happened about 4 or 5 months back. Even though they are average percentage wise. I believe Bank Nifty also similar story, 87.4% rollovers have happened, and market wide also 92%. So they are average in terms of percentage, but in terms of number of stocks which have seen rollovers, market wide rollover is much higher, and that does suggest from the 15,200 lows that we had made. We might see a bounce back coming in, but the only problem is that bounce back for the particular stocks might not come in July. It might come in August, but this does tell us that the selling which had happened in the last couple of months, that might stop, and which is a very good sign according to me. So yes, for this month we believe there will be range bound trading in terms of Nifty in between 15,200, 15,300 and about 16,000 levels. But the good part is, again, that amount of selling might not come in for July. Now looking at the PCR and the index open interest, I believe 15,500 is a very good support area. Even yesterday we saw Nifty bouncing back from 15,500. Some good grouping has been made in between 15,500 to 15,200, 300 odd levels. So I believe Nifty will take these supports and bounce back again. On the higher side, 15,800, 16,000 are strong resistances, with 16,000 having the highest call base. We might see some resistance coming in at 16,000 level. So broadly, there will be a 500, 700 point range in between 15,200 odd to about 16,000. From the stock specific front, looking at the overall stocks, open interest, which have been positive in terms of rollovers, have been HDFC, AMC. So this stock, I think the shorts have exited the system, which is a good sign for this particular stock. Similar is the case for Dr. Reddy, BPCL, IGL, SAIL. All of these stocks were under a tremendous amount of selling pressure in the last 3-4 months, and I believe the shorts have exited the system. So this will be a good sign for these particular stocks. In terms of Bharti Airtel, there were not much shorts in the system. Lot of delivery based buying has gone in. Stock continue to see long built up in the overall months. So these stocks are likely to perform well in this particular month. So look out for the same. In terms of stocks which might continue to witness some selling pressure, or a new selling will come in, are Asian Paints, Havells, AU Bank, Bharat Forge, and Marico. So high amount of open interest has been seen in these particular stocks, and these stocks are very likely to witness resistances, stiff resistances on the upside, and likely to witness a good amount of selling pressure coming in. So whenever some selling comes into the markets, these are the first stocks which one can look to sell on the downside. Now going down to the strategy. Now this strategy, so what we generally do with the strategy is we break it up into several parts, where we give a strategy only looking at the next weekly expiry, so you can get the best gains at that point of time. So at least for this next week, market is likely to remain volatile, and because of this volatility, we've given a long strangle, and because of this 15,900 call and 15,600 put, both one can buy for the 7th July expiry. We believe in this volatility, markets will hit either the resistance or the support, and if either of them are hit, the strategy stands to gain. 180 is your maximum loss, and about 300 points, 380 should be your target. However, if you do more than one lot per strategy, look to book profits once you get 100 point odd gain in your particular strategy. That can be a good gain for this particular coming week. Highest, there is an unlimited gain that you can get if the strategy goes above 16,000 odd levels, but we believe there will be resistance there, so good 100 point, 150 point odd gain would be great for the strategy. You can book profits there. Now going to the next strategy, we've given a strategy for Hindalfo. We believe now this is a monthly strategy. For this, we believe the metals, especially Hindalfo, has made a good bottom kind of a formation in the last couple of weeks. Even though other metals witness some selling, we've seen this particular stock witnessing good amount of bounce, and open interest that you see, the open interest is so high for this metals as a whole, even in Hindalfo, that there is a point now not many shorts can be added into the system, so they will have to witness short covering action. So once these stocks witness short covering action, you will see a very good bounce in metals and especially Hindalfo. So we've given a bull call spread here, where we believe one can buy Hindalfo at current levels, buy the 340 call at current levels and sell the 370 call at the current levels as well. So maximum loss that you're doing in the strategy is 11 points. Lot size is about 1075. So about 12,000 odd is your loss. Also your maximum gain is 19 points. So as a whole, you can keep a stop loss of 4 and do this particular strategy. I believe good amount of profit can be made in this strategy because as a whole, I and Amit both are seeing good bounce here, and you can look to add this particular strategy about 350, about 360. This stock will start to make profits, and going forward, it will be capped around 370. So that's it from my side. I'd like to ask fundamental team Sunil sir to please take over.
Yeah, thanks, Nirav and Swati. So you got a good perspective of the market from all the side. Now I'll request you people to put up your questions in chat box or Q&A section, so we can keep on answering those questions. Respective team will pick up the questions from there and will answer the questions. There are already few questions which has lined up in this Q&A box. So the major hot topic in recent past of yesterday was Reliance. So there is a question on Reliance key after the correction of almost around 8% yesterday. What could be the outlook? So the outlook seems positive. Why we say that? See, the questions was on the import export duty on petrol and diesels and all. But the point is like out of the total value of Reliance, only 25% value comes from oil and gas sectors, and 75% value comes from the other sectors like Geo and also the retail business. And some value also come from their new ventures which they are talking about. So out of the 600 rupees value day before yesterday of the Reliance, yesterday we lost around 200 rupees. So that is too much, and the other businesses are not yet impacted. So what we see that Reliance, the pain of the yesterday's government decision is now in the price, or maybe a bit larger. So quite possible we may see some recovery in the Reliance, or even from a bit longer term perspective, it looks good. As retail business is likely to show good performance in this quarter, no doubt telecom sector will be more of a sideway, but the results from the O2C business, that is oil and gas, will also be good in this quarter, but will get impacted in the coming quarters. So overall, what we see that the value is emerging in the Reliance share, and one can look to accumulate this stock. Another stock, another sector or stock which people are more concerned is about steel. We had seen a lot of corrections in the steel prices, and people are stuck in these sectors, whereas we were talking earlier also to come out of the commodity stocks. So our stand remains similar. We had seen correction in the steel prices of around anywhere between 18 to 20%. And there is a corrections in the iron ore prices also, and coking coal prices also. But if we take the maths of all these three commodity, net is that the EBITDA per ton declines. So overall, up till now, the EBITDA per ton from the equation seems declining. And apart from this, in the current quarter, people will see lower offtake because they're in declining prices, the volume reduces. And second thing is there will be a lot of inventory losses in this quarter. So for the near term, one should definitely avoid the steel sector till we see the results and till we see the economics of their selling price and raw material start showing again up move. So not bullish on that, and will recommend to avoid this sector. Yeah, Jan, if you can talk about AU Small Finance.
Yeah, so the main reason last couple of days the stock was down because couple of reasons. One was a report by Credit Suisse where they were arguing that the bank is very expensive, especially compared with the valuation of HDFC Bank and ICICI Bank. For example, HDFC Bank is trading at 2.5 times FY14 book value, whereas AU is at 3.5 times FY24. So that was their main argument, that it should trade at 3 times. That is what they said in the report. But we think that is a very narrow sort of thinking, and one should realize that loan book size of both the banks is completely different, and there is a long runway for growth, high growth in case of AU, where they can grow their loan book at 30% plus for next 3-4 years easily. That is not the case in case of HDFC Bank, where it will grow at around 20%. So we think the valuation premium is warranted, and that will remain, and it remains a good compounding stock even from this level. There is a question on auto sector also. What is the outlook? Demand is pretty good all these past months, but the only issue had been on the supply side, especially on the chip side. Now what we are hearing recently from Taiwan-based companies, even South Korean-based companies who are manufacturing chips, that their inventory is rising, and even the user industry's inventory is rising. So which is has resulted in couple of chip making companies reducing their guidances about sales for current year and even current coming quarters. So that gives an indication that globally the chip shortage scenario will abate, and this means good for auto sector as a whole, especially passenger vehicles firstly, and then even the high-end two-wheeler will benefit from this news. There is also question on Ashok Leyland, which I think Amit has already answered. But even from fundamental perspective, even if we look at the current month's numbers which came for the month of June, both Tata Motors commercial vehicle and Ashok Leyland have posted above expected set of numbers, and both numbers were almost 12 to 15% above expectation. And even on month basis, if we look, that is the kind of growth that we have seen, which is typically not the case because of seasonality which acts in negative side because of rains. The infrastructure works takes a back seat, but that is not the case, and in fact demand remains very strong over here.
Yeah, if technical team can take up some questions.
Yes, sir. There is three technical. I take a pick. That is Godrej Property, Pidilite, and UPL. See, Godrej Property, we see the positive momentum, and its momentum indicator RSI also cross over in positive. So we expect positive momentum in Godrej Property coming through presentation. But first, immediate resistance place around 1240. Above 1240, it will go towards 50 DMA. That is 1370 level. We expect positive momentum in Godrej Property. Pidilite industry also looks positive at current level. We see the yesterday as a positive momentum in intraday session also, and with volume breakout. We expect its break towards it's moving towards 2220 and upside. Downside immediate support place around 2130 at downside. UPL also looks positive, but we see the resistance in upper phase, that is 660, 666 in upside. If clear this level, then we expect further momentum towards 700 and above level. And support place around downside around 220 at that yesterday's close. We expect the trading in sideways momentum, but those have position, they can wait for target 660 and keep a stop loss 620 at downside.
I would like to answer on the Mindtree and the Pitti Engineering. Mindtree, as of now, the view will be a little bit cautious because the stock is trading below its 20 days moving average. The breakout level comes to at around 2930 level. If it's break that level, then 3040 and 3100 are the likely target on the upside, whereas on the downside, 2850 will act as the immediate support level. So those who are having any long positions, they can hold on but maintain the strict stop loss of a 2850 on a downside for immediate target of 2920 to 3040 on the higher side. Coming towards the petty engineering, as of now, the stock is well placed above its important moving averages. We are likely to witness a pullback rally on this particular counter towards 320 to 340 levels. So one can hold their long positions with the strict stop loss of a 290 for immediate target of 320 to 340 on high side. Thank you.
So I'll take up on Tech Mahindra.
Yeah.
Okay. So management had given a good guide. They had indicated that FY23 they would focus on organic growth and they would focus on improving margins. For the Q1, there is a Comviva business narrative which comes in, wherein management had indicated that the impact would be lower as compared to the previous year. Currently, the stock is trading at 13 times FY24 EPS. So outlook is long-term positive on the company. Thank you.
Yeah, Jain, if you can talk about Acrysil.
Yeah. On the demand side, there is some worry that because exports is around 80% of the business, and within exports, around 35% comes from US, 30% comes from Europe. So there is a worry that with these economies expected to go into recession, the new housing sales will be impacted, and which is a fact. But what we feel is that this product, more than going into new housing demand, it is more prevalent in the existing homes demand and the renovation work which people do. So almost 80% of the demand is from the replacement side and not from new home sales. All said, but still we feel that because the Western economies are on the downhill, there could be some impact. So we feel that stock, there is some upside to the stock, but one should not make fresh entry in the current scenario. And if at all the stock moves, let's say around 50-100 rupees higher from here, then one can look at switching to companies which offer better risk reward ratio and with a lower risk. For example, the couple of companies which we have recommended this month. So one can look at switching at higher levels.
So there are a lot of questions on IT sector as a whole, Infosys, TCS, and all. So this quarter, what we see that the result will be more of the volume growth will continue and will show good growth. But normally in Q1 there is a salary hike, and we had seen high attrition, and because of that the salary hike will be comparatively larger in this quarter. So there will be some pressure on the margin, and as such, what we see that the overall performance will be more of a okay. The concern is that the stock, the IT sector performed very well before all this period, and so substantial increase in their valuations. IT sector historically was growing at around 8-10%, but if you see in last year it has grown over 15 to 18%. And in the current year also, it is likely to grow by 15 to 18%. But market do not expect that this type of growth will sustain in the coming period, considering that the US and European economy are slowing down. So next year again, the growth can taper off and can come down to 12-14% and all. And as such, we had seen valuation corrections. Currently, the valuations are not at pre-COVID level. Still, they are a bit higher than the pre-COVID level. So, at current point of time, we do not see very big run-up or attractive valuations which forces the entry in these stock at current point of time. But anyhow, the growth will continue, and they will act as a more of a safer bet, and also are getting some benefit because of the currency depreciation also. So overall seems more of a hold type of situations. Any corrections from here post these results and all can give an opportunity when the valuation reaches back to the pre-COVID level. So like Infosys is right now trading at somewhere around 21 times FY24 earning. If suppose it comes down to 18, 19 times, means another around 10% corrections from here will lead to very attractive valuations which were being given pre-COVID, and we feel that those valuations are reasonable for these companies. So any corrections from here will make them attractive. There is a questions on Vedanta also. We saw corrections in Vedanta stock also. So here again, it's a mixed commodity stock. There are major valuation around 50% comes from the zinc. Then around 20-25% comes from the aluminium, and around 15% valuation comes from the oil and gas sector. So overall in 200 rupees, the value of the oil and gas is around 30 rupees, and we saw some corrections of around 10-12 rupees yesterday. So what we see that the impact of yesterday decision on oil and gas is in the price. But what we see that apart from that, the key thing is to be watched. It's a pure commodity play, and we are not bullish on commodity, and we are seeing some decline in commodity prices, and which we feel can still continue in the coming period, considering that the higher hard stand taken by the Fed to pull off the inflation. So as such, not bullish on Vedanta, and will recommend to avoid this stock at current point of time. Jian, if you can talk about HDFC, or technical team can take up that.
Yeah. Since HDFC most likely will be merged with HDFC Bank, we think we remain positive on HDFC. But from a fresh perspective, I would recommend that why to take even if there is a 1 or 2% chance of the merger or there is some issue going forward. Rather, one should focus on HDFC Bank. And we are bullish on HDFC Bank, ICICI Bank among large private banks. And if we see on the performance side and valuation side, at both sides, they are performing very well. On the valuation front, they are available at almost last decadal lows kind of valuations, with loan growth at whatever best they have performed in last 10 years. So we are getting this good combination, and in hindsight, we definitely think that people will think maybe a year down the line that these were very attractive valuations.
Yeah, if technical team can talk about IEX.
Yes, IEX currently looks negative. Still, we can witness some 8 to 10 points on the downside. The support for the stock is at 148 level. So if the stock breaks 148 level, then fresh round of selling can also be witnessed. So whomsoever holding long position which should place support at 148 level. The buying confirmation for the stock will come only above 168 level. Once if stock goes above 168 level, then only buying confirmation will come, and a fresh buying will be witnessed above 168 level. So hold you along with the support of 148, but if it break 148 level, then the next selling on the downside will come around 120 levels.
So there is a question on Aarti Drug also. So this looks attractive. No doubt Q2 will be, Q1 result will be more of a flattish result as compared to Q4. See, their main concern of the price correction is that the prices of raw material used by them has increased substantially in the past, which are somehow stagnant or cooling off since March. So the benefit of the same will be visible from Q2 onwards. So if you see their margins in the last quarter, they were at around 12.5%. And their steady state margins are somewhere around 15.5% to 16%. So there is a scope for margin expansion in the coming period. Then apart from that, they are even entering into, they are expanding their business of specialty chemical, and this is a high margin business with margins of anywhere around 24-25%. So as that business expands, their steady state margin of 15.6 or 16% will further expand, and management is looking at the margin expansion to around 17.5 to 18% over a period of next 1-2 years. So what we see that this looks attractive at current level. No doubt, immediate Q1 seems a bit flattish, but from Q2 onwards, we will start seeing benefit on that account. Even if you see the comparable company like Divi's, Laurus, or whatever, which are there in the API, are seeing some pressures in the recent past, but because of all the reason is similar, that the raw material prices were high, and finished goods pass on is taking some time. So once that situation reverse, which we see that possibility in the coming quarter, all these stocks will start performing. So outlook seems positive for Aarti Drugs.
Yeah, I will take next question, sir. So there is continuous question on ITC. See, ITC we have recommended buy call also in monthly report also, and in previous week we have recommended almost around 2 to 3 times for ITC to create a buy call. In ITC we are seeing a fresh long position from both front, technical and derivative front. The stock has given a major breakout about 282 level, and currently we are seeing that the momentum will be witnessed around 300 to 310 odd levels. So look, you can create long position at this level because volume we are seeing from last 1 week is continuously getting higher up, while the delivery buying is also getting increasing on the daily basis. So you can create long position in ITC. Stock looks positive.
I would like to take a question on Eicher Motor and VIP industry. The overall auto packs are really doing very well from the last 2 trading session on the technical front also. Eicher Motor, the view is definitely positive. This pullback rally is again likely to retest this 2900 levels, and any move about at level 3000 levels can be seen on the Eicher Motor, whereas the immediate support is placed at 2700. So those who are having any long positions, they can definitely hold on for immediate target of 2900 to 3000 levels for a stop loss of about 2700 on the downside. Coming towards the VIP industry, yes, from the last 15 to 20 trading session, we have witnessed a very strong pullback rally in this particular counter from almost 510 levels to 650 levels. Now from the 650 onwards, we are witnessing just a little bit profit booking, but the view will remain a positive on this particular stocks as long as it sustains above 600 levels. So 600 will act as an immediate support level provided by its 20 days moving average. So I believe it has a potential to again retest its 650 levels, and any more about that level, 700 levels can be seen. So those who are having any long positions, they can hold on with the strict stop loss of 600 rupees on a downside.
So I think we are towards the end of our today's meeting. So we try to answer a lot of questions from your query box, but still there are, I see that a few questions remain. So what we request is just post it on research@nirmalbank.com. So we will pick up from there, and we'll try to answer those questions. Thank you very much, and have a good day and a good month ahead for your investments. Thank you very much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.